One of the things that Tesla has been massively impacted by over the last 5 quarters is discounting their products. So discounting everything from the Model 3 and Model Y to the Model S and the Model X. But those discounts didn't stop earlier this year. They're actually continuing. They're just continuing in a little bit different form. Right now, Tesla is offering a 0.99% financing for the Model Y. I actually just got this offer in my inbox this morning. And this is just another way that automakers can offer lower prices, or in effect lower prices, to consumers. So why is Tesla lowering prices? Well, the real reason is there's a mismatch between supply and demand. It's not just Tesla, it's the electric vehicle market overall. Everyone is increasing their supply of electric vehicles, from General Motors to Kia to Rivian to Tesla, and the demand from buyers is not keeping up. So they're all having to lower their prices. Every single one of those companies has lowered their prices in some way, shape, or form over the past year. So I want to get into what exactly is on offer from Tesla and what the trends for the business have been, because these trends are not going to get better anytime soon. I know a lot of people earlier this year thought, you know what? Interest rates are going to come down. That's going to cause a boom in demand for Tesla vehicles. That's just simply not going to be the case. If anything, Tesla is going to have to subsidize these purchases, effectively lowering their margins even more than they already have. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's first get to what we know about Tesla's financing offer. This is from Clean Technica. I'll show a screenshot of the offer that I got this morning as well. But you can now get 0.99% financing for at least the Model Y. I've seen people saying that they've gotten this financing with actually $0 down. So that's a pretty good deal, especially in the current financing environment where interest rates are somewhere around 5.3%, 5, depending on the duration that you're looking at. But how does Tesla afford to do this? Well, they don't actually offer their financing themselves. They work through third-party financing companies like banks, and they're able to buy what's called buy down the interest rate. You can do this with a mortgage. You can do this with a car loan. You can basically pay extra money up front to say, you know what, I want to have a lower interest rate, so I'll pay for this interest up front, is effectively what you're doing. From a customer standpoint, you don't see it that way. You just see it as a lower monthly payment when you sign up for this financing deal. But for Tesla, you're going to take what they're getting for a purchase price from a vehicle. So let's take a Model Y, for example. $45,000 is where they start. If they put $4,000 into buying down those interest rates, they're effectively only going to get $41,000 for that vehicle. This is the latest way that they are cutting prices. But this is not the only way that Tesla has cut prices in the past. A lot of those price cuts have been more direct. Here's a few charts that I keep related to Tesla. The first one is revenue per vehicle. This really goes to show how Tesla views pricing for its vehicles. When there was short supply in the market of vehicles overall during the pandemic, during 2021, early 2022, Tesla was increasing their prices. You can see it's not small increases here. These are pretty sizable increases to the price of particularly the Model 3 and Model Y. In Q4 2022, that was when we really noticed that they started discounting vehicles. That was when that $7,500 tax credit was going to roll off. And so they started giving that benefit to customers through, at one point it was half of that was the discount, and then it was the full discount. And then we just started to see prices drop overall. And you can see that in the most recent quarter, the average sale price for vehicles was just under $45,000. So that's down really sharply from peaking at over $57,000 in just Q2 2022. So less than 2 years ago. You might say, well, they're just passing on cost savings. That's not really the case. You can see in this chart that costs are effectively the same as they were 3 years ago for Tesla's vehicles. Now, this is an aggregate number. It's just dividing revenue and cost of goods sold by the number of vehicles that were delivered. So this is not a breakdown on a per vehicle basis, but you can see that overall the numbers from a cost perspective, staying about flat, revenues are coming down. So why does Tesla keep cutting prices? Because they need to move vehicles through the system. When you're a manufacturing company, if you aren't maximizing your capacity, then you have fixed costs that are spread across fewer and fewer vehicles. That's the way to go bankrupt as a manufacturing company. You need to figure out ways to keep all of your factories busy. And this is exactly what Tesla is doing. This is what manufacturers have done for decades. And this is what makes the auto business so hard. they're having to discount these vehicles because there's more and more competition coming to the market. Tesla has always dominated the electric vehicle industry, not only in the US, but worldwide. And they did that with relatively few vehicles. Now you're starting to see 7-seat SUVs. You're starting to see low-cost SUVs, especially in China. There's more and more form factors answering more and more questions for consumers. And so maybe a Model 3 X, Y, or S doesn't work for one consumer, but an option from Volkswagen does work for them. These are the decisions that people just naturally make in the auto industry. And so that means that demand relative to the supply that Tesla has on the market is falling. This is why they have put off their manufacturing plant in Mexico and why they've turned, Elon Musk specifically, has turned the focus to FSD. You know what? This is an AI and robotics company. It's not an auto manufacturing company. Never mind that auto manufacturing is the most important thing for Tesla today. So let's get to exactly how this impacts the company's financials. Because even if you think that Tesla is now an AI or robotics company, we're years away from that being a sizable portion of the business. FSD is relatively small when you look at Tesla's business and revenue overall. And they still need to sell vehicles even if they are going to make more money on FSD. So what does the business look like right now? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. You can see that both gross and operating margins are starting to fall really rapidly. Operating margins now down to just 5.5% in the most recent quarter. Free cash flow, which was really strong late in that pandemic period, 2021 through the middle of 2022, has really fallen off a cliff. You can see that free cash flow was actually sharply negative, $2.5 billion in the most recent quarter. And even if we smooth all these numbers out and look at revenue trends overall, these are all trailing 12-month numbers, you can see that revenue is now starting to decline. It's really stagnated over the past 4 quarters. Net income doing something similar. It hasn't changed significantly since that December 2022 quarter, what I highlighted when prices peaked and margins peaked as well. So why is Tesla lowering prices? They're lowering prices because they have to. If they continue to make around 2 million vehicles a year and kept prices where they were, people would just look for alternatives that are lower cost, whether you're looking at China, Europe, or the US. This is what competition in the market looks like. The impact on Tesla, the stock, is that the company is simply not performing as well as it once was. Revenue growth has stalled out. Margins are coming under pressure in a huge way. We're now seeing Tesla operate at margins that you would expect from a traditional automaker. And the stock's extremely expensive. Price to earnings multiple on a trailing basis, 45. On a forward basis, 64. So incredibly expensive stock. A lot of growth priced in, but a lot of growth not being reported by the company. So a lot to handle there for investors. This is the biggest reason that I'm just simply staying out of Tesla stock, because I think it's extremely expensive and it's not a high profitable automaker anymore. And that's what we were promised a few years ago. So what do you think about Tesla stock and the cost reductions that they continue to have to do quarter after quarter? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.